For a change, stocks didn't set fresh all-time records today. But you know better than to believe that. They did it again, and there's no oops attached. The major indexes, all of them, closed higher today than ever before. You've heard that a lot lately, but here's something you haven't. The S&P 500 is having its best start to a year since 1987, and not since 1964 has the S&P 500 set 6 consecutive records to begin a year. Investor optimism is high. Here are the happy and not at all fake numbers for the day. The Dow advanced 102 points to 25,385. NASDAQ added 6, and the S&P 500 was up 4. Now comes the moment of truth, quarterly profit results. And as Bob Pisani reports, expectations are very, very high.
It's been an amazing start to the year. The S&P is up 6 days in a row. It's about 3%. Its best start since 1987. Earnings season is now upon us, and with prices and valuations at record highs, it's fair to say expectations are also very high. This past quarter has been very unusual. Analysts have been even more optimistic than they usually are. They typically start optimistic and then they lower earnings expectations into the quarter, but that didn't happen in the fourth quarter. With prices this high, investors are clearly hoping there will be bigger beats than usual and will likely punish companies with inline or disappointing numbers much more than usual. And guidance is also an issue. Of the companies that gave guidance each quarter, only 1/3 will typically raise the guidance, 2/3 lower guidance. But thanks to tax cuts, investors are expecting more companies to raise their guidance than typical. That could be a problem, particularly since many companies are still not entirely sure of how much the tax cuts will help their earnings and may be reluctant to say anything this early. Then there's buybacks and capital expenditures. Again, thanks to tax cuts, investors are expecting companies to announce some combination of more buybacks or increased capital expenditures. So can the CEOs really deliver on these high expectations? It's a pretty tall order, but their early returns give some cause for optimism. So 19 companies in the S&P have reported earnings so far. Oracle, Carnival, Darden, Walgreens, FedEx, CarMax among them. The average earnings growth has been 18%. Sales have averaged 11% growth. That's good. That's well above current expectations of a gain of 11% for earnings and 7% for revenues. We'll see what happens from this point on. If the companies start pushing buybacks and more capital expenditures, it's possible this rally could just keep on going. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.